It's decision day for the Fed, the final rate call of the year. Traders bracing for a cut with a spotlight on the dot plot, fresh projections, and Chair Powell's guidance on the path ahead. Volatility around the rates outlook has defined markets for weeks, eclipsing talk of AI bubbles and trade spat. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Investors seem to be looking at China's higher consumer price print as a sign the PBOC won't be lowering rates anytime soon. CPI accelerated to the fastest pace in over a year, even as deflationary pressures remain. We'll get a view on the markets from JPMorgan Asset Management's global strategist and ask where investors should look for yield. Bloomberg Economics sees India's economy losing momentum through early 2026 as the delay in a trade deal with the U.S. chokes exports, pressures the rupee, and spurs capital outflows. We ask HSBC's chief India economist whether Trump will call the shots on India's economic fortunes next year. And we'll look at the business and investment climate in the country. The CEO of recently listed Lenskart will be joining us at the top of the next hour. Also ahead, we speak to Barclays Bank's India CEO and Vice Chairman for APAC Investment Banking. It's all about the rates outlook for markets. Most Asian stocks are weak, with sentiment on Chinese equities being hit after consumer price inflation rose in November, damping expectations for lower interest rates. As investors await clues on the Fed's policy path, White House National Economic Council Director Kevin Hassett said he sees plenty of room to substantially lower rates. A Bloomberg report earlier stated that Hassett is the front-runner in President Trump's search for the next Fed chair.
Jay Powell has done the right thing, which is he's taken the far-left people of the board and he's coalesced them around, it looks like, a rate cut, which is the right move right now. I might like a bigger one, but I think that that's what the Fed chair has to do. Don't forget, you're managing a committee. And so getting rates down right now, it's a good thing. There's a lot more room to go.
And here's a closer look at China's latest inflation report. Consumer price growth accelerated to the fastest in over a year in November, even as deflationary pressures remained widespread. For more insights, let's bring in Bloomberg economist David Chu. And David, when you take a look at PPI, falling for the 38th straight month, you got to be worried about this economy.
Yes, definitely, because if you look at the profitability of the industrial sector, you will see that it is highly correlated with the PPI. Well, when the government helped the CPI side using the anti-involution approaches, the divergence between the CPI and the PPI actually is more concerning for me, because it means that the producers, they cannot make more profit because of the limit of output. So that putting everything together, yes, I think that the deflation or disinflation is still a great pressure to the U.S. economy, to the China economy.
David, isn't it true that the PPI headlines don't even tell you the real extent of that slowdown?
Well, we cannot say what the real slowdown is, because the CPI or the PPI is not so correlated with the production side. But all in all, we think that if the disinflation or deflation pressure continues, it will weigh on the production side, because if the producers cannot make money, they will have to choose another strategy.
David, overall, this shows how, there is a broad slowdown that is gripping China. What measures do you think China will take to address the weakness?
Well, people are Yeah, including me, people are looking at the upcoming Central Economic Working Conference that is going to be held maybe this week. So people are eager to see what the government is going to do for next year. But for me, I think one thing is for sure that the government needed to boost the domestic consumption. That is because of the background of the challenge in the trade sector and also the slowing and the drop in the investment side, so that you need something to boost the total demand. That is the hope, the consumption is the hope. Otherwise, if you have a strong production but a weak demand, that means one day you will see the loss of profitability of the corporates, and then it will limit the production side and slow down the economy. So putting all the things together, I think boost the domestic consumption will be one of the priorities that the government needs to do.
And that remains to be seen. David, thank you so much for that. Bloomberg economist David Chow there. Now, China Vanke meeting with bondholders today to discuss a proposal to delay payment on the 2 billion yuan bond note due December 15th. For more, let's bring in China credit reporter Trista Sinyilor. Trista, what is anticipated? How might this proposal look like?
Yeah, so in today's meeting, bondholders will discuss 3 proposals. The first one is actually proposed by Vanke, and they are asking to delay the yuan bond payment for 12 months without any upfront cash or any installments. And there are another 2 which are offering more generous terms, asking Vanke to pay interest on time and also offer some credit enhancement. So in today's meeting, bondholders will review those proposals, and they will have until Friday to vote.
What is the likelihood that Vanke will get the votes it needs?
Yeah, so, any proposed change will need over 90% support from the creditors. So Vanke right now is, asking for one more push to win more support from creditors. There have been a lot of ongoing discussion even before today's meeting. During the weekend, there was a meeting held in Beijing, and then yesterday, Vanke's representative actually reached out to some creditors saying we can pay some interest, but they didn't specify how much. So there's still a question mark there, and we really need to wait and see the final result coming from this, today's meeting and also the voting. So I think overall, any discussion ongoing right now is still just buying time for Vanke. And moving forward, I think investors are largely expected that there will be a restructuring coming ahead.
Well, Vanke has been given a lifeline before. What are the chances we could see that again?
I think investors are not expecting any more further strong support from the government or from Shenzhen Metro, its largest shareholder. I think right now it's more like relying on Vanke itself, and also they're seeking support from the bondholder to help them to get through this, difficult time. I don't think investors are thinking more big support gonna coming from the government side. So I think right now they are actually relying on the current proposal, help them to cut debt and help them to relieve the liquidity strains and to avoid the immediate default.
And Trista, of course, lots of implications for the property sector as a whole. What are you hearing? Is sentiment turning, much worse than before?
I don't see any positive sentiment already pick up there. So that's also one of the reasons why Vanke will, going through such a difficult time right now, because Vanke could see its sales actually plunge 40% of this year. So so that's the fundamental question about why those developers still suffering a lot nowadays. And right now is actually the time which bondholder need to reassess the proposal and try to make a decision right now.
Trista, great insights. Thank you so much for that. China credit reporter Trista Sinyilor there. Still ahead, JPMorgan Asset Management discusses the Fed's rate path as markets look ahead to its last rate decision of the year. Keep it here with us. This is Bloomberg.
The good news is that the Fed is cutting from a place of strength. They're not reducing interest rates in order to stave off a nearly inevitable recession, but rather simply just trying to bring down what is currently a restrictive policy down to something that's more neutral. And historically speaking, when you've had a central bank cutting interest rates after an extended pause, that's typically been very bullish for both the economy and markets going forward.
Yeah, I don't think we're going to see any changes to the dots. I don't think we're going to see any changes to the statement at SEPs. I think Powell will basically come out and say that they're open-minded towards moderate rate cuts if they're needed, but obviously the barriers to do so are much higher these days. We're going to see the formal end to the recalibration phase.
Some of our guests sharing their insights on the upcoming Fed decision. Well, my next guest expects the Fed to cut rates by 25 basis points this week and sees 2 additional cuts by the middle of next year. Marcella Chow is global market strategist at JPMorgan Asset Management. Marcella, good to have you with us. Even as you're pricing in 2 rate cuts next year, it is pretty much data dependent. You can't be so sure.
Indeed. Right now, we believe that during the meeting tomorrow, most likely Chairman Powell is going to highlight it's going to be a meeting-by-meeting approach. In terms of what the market should pay attention to, most likely will be about the summary of economic projections. We expect that the inflation forecast might be downgraded a little, but overall it should be remain broadly unchanged. And then the dot plot should also be roughly similar to last time. But I think what market will pay attention most likely will be to what the risk assessment going forward will be, whether it will be more balanced. And if it's more balanced, it might set the tone to the market that is a more hawkish tilt. And given what the job labor market report that we got from Jokes last overnight, that was slightly better than expected, that might suggest that it's a hawkish market tilt, that there might need to be more further job labor or job market weaknesses to warrant further rate cuts going forward.
I just want to point it out there that the rate cuts we're anticipating is pretty unusual. Usually the Fed cut rates when growth is slow, when inflation is low. Not the situation right now. So the dot plot becomes much more important this time round. I'm just wondering, what assumptions are you making, given that we have a Fed that's pretty divided on what needs to be done in terms of the path going forward? Indeed.
It's pretty divided since the previous few meetings. And so going forward, it will still be the case. But it seems like right now it's a risk management move, and they are focusing more on the labor market weakness from recent few data points. And yes, overnight we got a slightly better than expected number, but still we do not expect that to change the sentiment for tonight's meeting. And also going forward, I think the labor market weakness, once after this data vacuum that we have more clarity, then like you said just now, it will still be meeting by meeting and more focusing on the labor market weakness to ensure that the growth momentum can be sustained in 2026.
Where do you see Fed funds by the end of 2026? Bearing in mind, of course, Trump wants, the long end of the curve to be much, much lower from here.
Right now, we're expecting 2 more after tomorrow, probably 2 more 25 basis point cuts before by middle of 2026. But it will also having to depend on, for example, because we right now expecting that 2026, the first half of the year, might be boosted by, for example, a temporary boost from tax rebates and also higher disposable income. That might actually cause an inflation to remain sticky. So that suggests that going forward, this will still depend on the data. But then it will still be an easing bias to expect the rate to reach the neutral level around 3% by mid-2026 next year.
What's key right now is actually the long end of the curve. 30-year yields expected to rise to above 5% and perhaps stay above 5%. What's your take on that?
Right, definitely going forward with the Fed chairman or election process still in progress, the focus will still be there, and also because of the fiscal deficit or the independence remains in question with regards to Fed. But then actually recently we see that this was mostly happening in the first or in the second or third quarter. Since we arrived to the fourth quarter, market focus was also remaining on more the dual mandate of inflation actually seems to be weaker than expected, but the labor market remains weaker than market expectation. That's why the Fed is focusing more on maintaining this dual mandate and ensuring the growth momentum to sustain, and that they're doing the cut. And going forward, we still expect that the first half of this year, they will still try to maintain this easing bias, but then the pace and the magnitude will very much depend on if we expect that the market data coming in is actually stronger than expected, they may actually do less or slower. But then if it's actually weaker than expected, they may do more, but then it's still prone to an easing tilt or easing bias.
Marcella, as we look at 2026, some say perhaps we might just see a tale of two halves, a stronger first half and a weaker second. What's your take on that, and how would you deploy capital, assuming that is what we will see next year?
Yes, indeed. So we do think, given the current earnings momentum and economic growth still relatively resilient, that should actually sustain for the first half of this year. Of 2026, and that will actually be constructive on equities and similar to what has happened throughout 2025. But then as the fiscal support wanes and also probably with inflation numbers remaining quite sticky and persist, the second half of this year, we actually advise investors in 2026 to move to or shift to a more balanced stock bond portfolio, and also maybe reach out and look out for alternative income generating assets. But then in terms of the global market momentum, we see that it's going to still be constructive for risk assets general, as we are still in a rate cutting cycle, and also most probably will still be led by AI, and also in US and also broadening out to Asia Pacific.
Which sectors do you see the best opportunities? Do we still play the AI theme in 2026 in as big a way as we did in 2025?
Yes, for AI, we remain quite constructive on, for example, AI data center and also computing power. But yes, like you said, in difference to 2025, I think there will be more divergence going forward. So identifying or being active in company selection remains key. And also, there will be more questions about or debates about AI overinvestment. And also going forward, the key will be the ones that can actually overcome all the supply constraints or supply bottlenecks. For example, electricity supply for the ongoing explosive demand for data center. Those that can actually overcome the supply bottlenecks will likely differentiate and yield a better return going forward in 2026. And also, as we were alluding to with two halves, in the second half of 2026, when we actually see investor sentiment gradually shifted to a bit more sour, other than shifting to a more balanced stock bond allocation, probably also into a higher quality and defensive portfolio with more focus onto the defensive sectors like financials and energy and utilities. Those will be probably more applicable for the second half of the year.
Marcella, I just want to draw your attention to the allocation for AI plays. I mean, there's always this debate between the U.S. and other markets, including the likes of China as well as Korea and Japan. What distinction are you making and what kind of allocation are you considering?
Indeed. I think U.S. The U.S. AI will continue to focus on the U.S. innovation, but we see that China has actually been developing its own self-sustaining ecosystem, given its policy support and strong supply chain and also research. And so this one will, going forward in 2026, AI will probably be one of the key growth drivers within Asia, bringing in probably even more better return for hardware like Korea and in Taiwan. But then I think going forward in 2026, what investors need to identify is not just looking for the innovators, but also focusing on the enablers in, for example, in industrials and utility sectors, and also the adopters, in financials or healthcare, suggesting that is a broadening out for AI industry development, even across the sectors. And in recent earnings call in China, we've seen that they've highlighted how it's not just benefiting technology companies, but it's actually a key core part of all the business strategies and operations across various sectors. So this will be key for 2026. And as broadening out that we've also called for action in 2025 remain in 2026, but broadening out within AI will be what the key focus will be for 2026. So it might not be what we're expecting broadening out across all sectors, but a narrow broadening out within AI developers and also finding hardware, hyperscalers, and also AI developers and also the emerging application providers with a focus of also the end demand and also the monetization.
We're getting a clearer picture of China's economic situation. Today, we see deflationary pressures continuing for 38 months. We have Vanke, raising concerns about the property sector. Are you assessing these risks when you talk about, investing in a market like China for 2026?
Indeed. We see that the trend earnings per share growth has been trending down because of, like you said, the deteriorating GDP and also the ongoing deflationary pressures. But yes, property sector is one of the key pain points, but and one of the disappointing side where we did not actually see a lot of announcements or support related to that in the Politburo meeting. So the focus will be next on the Central Economic Work Conference, where the numeric targets will be discussed and probably be announced in next March 2026. But other than that, given how the property market recovery was more muted than expected, we actually have been searching for other growth drivers. For example, the ongoing anti-inflation campaign would actually be helping to lift profit margins and also restore the pricing power for those over-competed sectors. And secondly, we have actually seen a lot of household allocation into both onshore and offshore equities. So going forward, those will also be quite encouraging profit drivers for China markets.
Right. Marcella, thank you so much for that. Marcella Chow, Global Market Strategist at JPMorgan Asset Management. Still to come, Australia's social media ban for youth comes into effect today, a landmark move that's drawn global attention. More details just ahead. This is Bloomberg.
This reform will change lives for Australian kids and allowing them to just have their childhood. For Australian parents, enabling them to have greater peace of mind. But also for the global community who are looking at Australia and saying, well, if Australia can do it, why can't we? This will make an enormous difference. It is one of the biggest social and cultural changes that our nation has faced. It's a profound reform which will continue to reverberate around the world in coming months to assist not just this generation but generations to come.
Australian Prime Minister Anthony Albanese speaking about his government's social media ban for youth. It's a landmark move that aims to keep those under 16 off certain social media platforms. Children can no longer have their own accounts, and firms violating the rule face fines of up to $33 million. Companies including Facebook, Instagram and Snapchat are subject to the new regulations. They've all pledged compliance, but some firms say the rules have been rushed through and risk pushing children into more dangerous corners of the internet. The Australian government estimates 86% of the children in the country aged 8 to 15 use social media. The world is closely watching Australia's move. Policymakers in Europe and Indonesia are also looking to rein in big tech, even as the industry sees young users as key to fueling future growth. For more, let's bring in Bloomberg's tech reporter, Newly Purnell, and opinion columnist Catherine Thorbeck. Let's start with you, Newly. I mean, so many questions, right? What's been banned? How is it being enforced? And how do you actually ensure what age you are online? How do you verify?
Right, Haslinda, right. All of those platforms you just mentioned are banned, and there's 10 in all, including some of the most popular ones among young people. So TikTok, Instagram, even some that are not thought by many people often to be social media platforms like YouTube, controversially is included. YouTube's not happy about that. The tech platforms say that they have always had strong safety mechanisms in place, but they're now rolling out new features like the ability to submit video selfies or upload ID documents. So far, not seeing a huge number of issues, but we did see, as of yesterday, some younger users taking to other platforms like TikTok and saying that they disapproved of this, and we're also seeing some adoption of some other apps that aren't included in the ban. But a really significant global move here from Australia and really putting the onus on tech firms. They're saying, you got to do a better job. We don't want our kids under 16 on your services anymore.
Catherine, we know why this is being done. The question really is whether it will work. I mean, we've talked about how kids can go underground. This could be unregulated space for them, which is even worse.
That's right, Haslinda. And, you know, there was a poll that came out in a local broadcaster ahead of this ban, which said that 75% of 9 to 15-year-olds had no plans to stop using social media just because the ban took effect. And we know how tech-savvy young people are. They're always finding sort of workarounds to this. And another thing we sort of observed was that teens were sort of encouraging each other to congregate on more obscure apps. And it really raises the question of what could go wrong when swarms of underage users are going to even less regulated corners of the internet. So I think there's a lot of big question marks hanging over this at the moment.
What are the biggest concerns when it comes to this legislation? What's been brought up?
So I think there's some valid privacy concerns. There's also concerns that this will have a bigger impact on sort of marginalized teens, whether that's rural or indigenous youth who really rely on social media for community. But a big thing that I've been following is that the American Psychological Association actually does not recommend hardline age limits. They say that they're not effective at keeping teens safe online. And the reason for that is interesting. It's because it doesn't address sort of the underlying problems of the problems that emerge from these platforms. So they might keep some 15-year-olds safe, but then they just throw them into this sort of burning building as soon as they turn 16. So I think that there are other ways to sort of regulate big tech. But now that this, ban has come into effect, as I mentioned earlier, I'm really rooting for it. I really do think it's putting Silicon Valley on notice.
It is about child protection. It's also about freedom of expression, Newly. I mean, you got to wonder, what the tech companies would do. How will they respond? What's a threat to them? Can we quantify that?
Right. Well, Australia is obviously not an enormous market in terms of overall population, but there are probably, the Australian government estimates, around 1 million or more people who will be affected, young people who will be affected about this. What's been unusual in my time covering tech policy issues like this is oftentimes governments will talk about issues or new regulations, and the tech firms don't really say much because they don't want to, draw more attention to the issue usually. This one's a bit different. Since the law passed last year, the tech firms have been very vocal, saying that, as we mentioned earlier, it seemed like the legislation was rushed through. They say they have robust safety mechanisms already in place. Some of the other issues that Catherine mentioned, but they've been very vocal about that and have really only begrudgingly, late in the game, said they'll comply. The global perspective, I would just say, analysts we talk to say no companies really want to be regulated if they don't have to. And what the issue for the big tech firms is that the young users are the ones who provide future growth. These companies make money off of advertising revenue. They depend on users on their platforms in the years to come. And perhaps if young people in Australia, if they put off joining, maybe they might not join at all. Or maybe it will become the social norm. Maybe it will be uncool to be on social media. So they want to stop this, and they don't want to see these rules spreading around the world. And they just say they're misguided.
And Yuli, as Catherine said earlier, other countries are looking at it very closely. Indonesia, case in point, it's not the only one. Several other countries, perhaps even Singapore, is looking at it.
Right. In our reporting, one of the interesting things that we have brought to light is that since the law passed last year, you have an increasing number of governments saying we are taking inspiration from Australia. They're showing it can be done, and we want to follow suit. So we spoke with a senior policymaker in Denmark who said she finds what Australia is doing to be admirable. We know that Indonesia is talking about similar rules. Brazil, a huge market, a huge and young market. And then in Singapore, they have said that they are talking to their counterparts in Australia about age assurance measures, could take different forms. But yeah, we very much see that lots of countries, including these big developing markets that have huge pools of younger users, are talking about similar rules.
And Catherine, you're quite open about, agreeing with the move. I'm just wondering, what implications are there for the kids out there, right, in terms of digital literacy skills that could impede, that could perhaps limit how they grow in this space?
Right. So I think that we definitely need to have more robust sort of online digital literacy sort of courses. And we definitely need to talk to kids, caregivers and guardians definitely need to talk to kids more about, what they're doing online and really open that sort of conversation up. I don't necessarily think those have to be mutually exclusive with tighter age limits. I think one thing we have learned over the past few years is that really the status quo is untenable. We've heard so many really heartbreaking and devastating cases from parents of harms linked to social media. So I think it's good that Australia is doing something. And, what I've written about is that that's more than can be said for Washington, which really hasn't passed a comprehensive online child safety regulation in decades.
It'll be interesting how the other countries respond to it. Thank you so much for that. Bloomberg's tech reporter, Newly Purnell, and opinion columnist Catherine Thorback there for us. Still to come, how delays in a trade deal with the U.S. is putting India's economy under pressure. We'll get insights from HSBC's chief India economist. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We have headlines on the back of the tensions between Cambodia and Thailand. And we have Cambodia now saying that Thailand dropped 2 bombs via the F-16s on Wednesday. We heard earlier, of course, from the Thai Ministry of Defense spokesperson Surasan Kongssiri, briefing reporters saying that Thai military operations are still ongoing there. Over 400,000 Thais have fled that border conflict areas, according to the spokesman, and that Thai military operations are still ongoing at this point in time. As you know, clashes have raged for a third day along the roughly 800-kilometer border, with the Cambodian Defense Ministry claiming that Thai shells killed 2 civilians overnight, raising the death toll to 6. And we see that tension ongoing as we speak right now. And we're also hearing from President Trump, who claimed victory when it came to that peace deal that he struck between the two sides, he's now saying that he'll call on Thailand as well as Cambodia over the renewed conflict. President Trump, of course, took credit for the peace deal, which was struck just several weeks ago when he was on his Asia tour. Again, we're seeing a resurgence of tensions between Thailand and Cambodia. Now, back to the markets. We're looking at Indian markets just ahead of the open. This is how it's looking as we count down to the Fed decision, which is impacting markets pretty much across Asia. We're seeing the Nifty futures currently flat, 25,916. The Sensex under pressure, down about 0.1%. The rupee, though, remains front and center, whether or not we're going to see further intervention and support from the RBI. Now, Bloomberg Economics says India's economy is set to lose momentum through early 2026 as delays on a U.S. trade deal choke exports, pressure the rupee, and spur capital outflows. Let's bring in Bloomberg senior India economist Abhishek Gupta. Abhishek, how are Trump tariffs affecting the Indian economy, and how's that shaping your views on the economy?
Thanks. So what's really happening this time around is slightly different when we've seen pressure on the rupee historically. Currently, you are in a situation where high growth is also contributing to higher imports, be it gold imports, some of which is also due to speculative investment, but also non-oil and non-gold imports are rising steadily. Part of it is also due to India's tax cuts, which is boosting consumption. Typically, whenever this happens, you have inflows on the capital account to balance the current account trade deficit. But this time around, because of Trump tariffs, you are seeing a situation where you are also seeing outflows on the capital account. So I think the situation should be manageable for another few months in the short term if an India-US trade deal comes through maybe by the end of this year or by early next year, even in 1Q 2026. But if things get delayed further, I think this external headwind situation could soon turn into a crisis situation, and that could really slow down growth further going forward.
Abhishek, do stick around. Let's get more insights with Pranjul Bhandari, Chief India Economist and Strategist at HSBC. Pranjul, do you share that view that India's economy is poised to slow down in 2026? It's all dependent on the trade deal with the U.S.
Well, I think that's one of the factors. I do think that in the first quarter of 2026, there are several reasons why India's economy could lose some growth momentum. We've already seen exports to the US slowing, falling 10% year on year. Some of the boost from GST tax cuts are now starting to come off a little bit. And then we had a lot of fiscal expenditure, both by center and states, which was done upfront, which could slow in the first quarter of 2026. So my sense is, yes, growth could slow a little bit. But I also have a base case view that hopefully by March, we'll get a trade deal done, which will not just be good for exports, but also for sentiments. And then, towards the middle of the year, things could start to bounce back up again.
So what's the reason for the unusually strong GDP numbers which we saw recently in India?
Well, look, it was a very strong number of 8.2%. I think there were both sort of, cyclical tailwinds. We've had great rains. We've had both monetary and fiscal policy easing. We've had the GST tax cuts, and all of that played a big role in boosting consumption. But then there was also a statistical issue part of it as well. Our sense is that there are a couple of deflator issues, and once we try to quantify it, the growth which came out as 8.2% is more like 7% on the ground. Now, 7% is also a strong number, but our sense is growth wasn't ever as strong as 8.2%. I do think that this deflator exaggeration will continue until March. So for the full year, which we call FY26, we could get official numbers for the year averaging 7.7% GDP, but the real growth on the ground could be more like 6.7%, 1 percentage point lower, which, by the way, is also fairly strong growth performance.
Abhishek, how do you think the RBI is assessing the growth projection for India? It has a dual mandate. of growth as well as inflation benign?
Yes. So if you look at RBI's December policy, they have revised up their GDP growth projection for the full year to 7.3% from 6.8%. But that's not forward-looking. Most of this growth increment is already in the rearview mirror. Growth in the first half of the fiscal 2026 averaged about 8%, and RBI's own assessment is that it's going to slow down to about 6.8% in the second half of the fiscal year. We think it could we're slightly more optimistic than the RBI in terms of the growth numbers for the second half, but still we also see a sharp slowdown to 7.2% over October to March from the first half in fiscal 2026. In terms of inflation, RBI has been revising downwards its inflation projections ever since February last year. It's made 5 downward revisions on the trot, and now it's forecasting 2% inflation for full fiscal 2026. Its inflation projections going forward continue to remain elevated. It's projecting 3.8 and 3.9% in 1Q and 2Q of fiscal year 2027. We sense that inflation will continue to undershoot RBI's forecast, largely because food prices would continue to remain contained. You've seen bumper rains last year, and this year again you've had good rains, and that should prompt good food supplies to last through the end of the agricultural year in June 2026. So all of that means that food prices aren't likely to rebound sort of as sharply as the RBI is expecting them to. Our own forecast is that overall headline inflation would remain contained at 3.2% in fiscal 2027 as well. There is a big risk to these projections. In February of next year, the government would be undertaking a major revision of inflation and growth series, and how that kind of changes the numbers is unknown. Our sense is that inflation could be revised downwards, and while the level of GDP is likely to be revised up, it's difficult to say what would happen to the growth trend numbers over the last few quarters.
Pranjul, given all the uncertainties out there in 2026, what would it mean for the Indian rupee, currently down about 8% versus the USD? Might there be a reversal of fortune? And what might that take?
Well, yeah, that's a great question. And I think the fact that the rupee is weakening, and on a real effective exchange rate basis, it's weakened 10 to 12% already. I think that's a good thing, because what it does is that it's the perfect medicine at a time we've got such a big tariff problem, a 50% tariff. Now, the tariff reduces the competitiveness of India's exports, but the rupee depreciation raises it back up. And in fact, it's very, very positive for services sector and services exports a lot more than it's for goods. So my sense is the fact that we're allowing the currency to depreciate could over time actually increase the competitiveness of India's exports, and the exports could rise back up, the current account deficit could stabilize hopefully over time, inflows could come back if exports are good, growth is good, and my sense is that there could be some auto correction. In fact, if you actually just plot the rupee in a real effective exchange rate basis over 10 years, you'll find that it always mean reverts. Once it's weakened a lot, then there is an automatic stabilization, your exports become competitive again, and your external balances improve, and your rupee bounces back. So the fact that we are allowing the currency to depreciate at this point of time, I think is the right strategy. Generally, we get scared about rupee depreciation from the angle of inflation, but this time around, my sense is that inflation will remain quite low for quite long. In fact, we too believe that it's going to remain below the RBI's 4% target for at least the next 2 years. Our sense is that the drivers of disinflation this time are a lot more sticky. For example, exported disinflation from China is also playing an important role, which we think is not going away anytime soon. So on the back of that, allowing the currency to depreciate will not really add to too much headline inflation at this point of time. And from that perspective too, we can allow the currency to really correct, so to act as an automatic stabilizer and a shock absorber at a time we've been slapped with such a high tariff from the US.
But Abhishek, the question is if the RBI wants to put a floor to the rupee weakness, can it do that when some of the factors that have been cited are actually external factors like the trade deal?
RBI does have a very good chest of FX reserves. It's almost nearing $700 billion. It has lost a bit of reserves. Our estimate is it has lost about $35 billion or so since in July or mid-July. But then it has also recouped some of those reserves because of revaluation gains. Gold prices have continued to rise, which has also kind of stabilized RBI's overall FX reserves. Going forward, I think the RBI will continue to have this firepower to defend the rupee, but not for too long. So just like Pranjul, we also expect a U.S. trade deal to sort of culminate by the end of March 2026. But if there are delays beyond that, and that could be a big risk, because then this external headwind situation could soon turn into a crisis situation, because if India's growth continues to be steady and imports continue to remain high, the high trade deficit could continue to pressure down the rupee, in which case RBI can't just continue to sell FX reserves. At that point in time, speculation could also kind of build against the rupee, and RBI would find it difficult to maintain an orderly sort of weakness in the rupee.
Right. And Pranjul, it's all relative, isn't it? When you talk about rupee weakness, it's not as weak as other currencies like the yen and the yuan. I'm just wondering how competitive Indian exports can be when compared to Chinese exports, given where its own currency is right now.
Well, I think, when we compare India's exports to other economies, I think we need to understand that India is a little different in the sense that about 50% of its exports are actually services and not goods. And what impacts services can be very different from what impacts goods. And at this point, my sense is that the fact that it is sort of creating a name in this whole outsourcing of professional services exports and all of that is basically allowing exports to remain strong despite all of the bad news on the tariff front, and the fact that we are allowing the currency to depreciate. The real has depreciated by 10% this year. That also is very positive for services exports going forward. So I think all of this is something that is sort of unique to India. A final point I wanted to say that a lot of exports is changing in nature now. We should think about goods exports and services exports. Right. But now we have a lot more hybrid goods where India is a leader. So I think India does have its space to grow despite all of the tariff uncertainty around us.
Pranjul, great stuff. Pranjul Bhandari of HSBC and Bloomberg senior India economist. Abhishek Gupta, very quickly, let's do a check on Indian Indigo stock. India's asked Indigo to cut 10% of its flight routes to help stabilize the airline's operations and reduce cancellations. It is extending its flight to about 1.5%. More to come in our next hour of Insight. This is Bloomberg. Welcome back. You're watching Inside. We're tracking Indian stocks. They've been trading for 15 minutes now. They've been under pressure on the back of uncertainties to do with that trade deal with the U.S. The Sensex, though, now inching upwards, up 0.2%, a positive tone in the market, though. Keep a watch on those small cap stocks. They've sharply trailed their larger peers, dealing a big blow to retail investors who have been the backer of the stock market in India. Again, the Sensex in positive territory. It is a positive sentiment pretty much across the board in India. The Indian rupee in focus currently, it is down 0.1%, continuing to slide versus the USD, close to record lows. 89.97 is that level we are looking at right now. Now, the latest IPO in India begins trading at 1:30 the hour. SoftBank-backed online marketplace Meesho raised about $603 million in a public offering that was more than 79 times subscribed. It is the latest in a flurry of Indian companies rushing to capture booming investor demand for new shares. Meesho plans to deploy listing proceeds to penetrate smaller towns in India. And staying in India's consumer space, food delivery firm Swiggy has launched a new share offering for institutional investors just a year after its market debut. It's aiming to raise $1.1 billion as India's rapid commerce market expands and competition ramps up. Like Meesho, Swiggy is competing against Amazon and Walmart to build dense networks of warehouses and delivery fleets capable of fulfilling orders within minutes. Now, the move comes as the stock price has reverted to near its IPO price. And we're also keeping an eye on Lenskart, which recently went public. The company's shares are up slightly since debuting last November. Lenskart is an Indian multinational eyewear company with over 2,500 global stores. It holds a majority stake in Japan's Owndays and Spain's Mela, and recently partnered with Mart to launch a Labubu-themed eyewear collection. Joining us exclusively, Peyush Bansal, co-CEO, or rather founder of Lenskart. Good to have you with us to talk about the outlook for the company. First off, that tie-up with Labubu, Mart, I mean, what is the strategic thinking when it comes to that partnership?
Firstly, thank you for inviting me to Bloomberg TV. Well, I think consumers are now bored of what they have been wearing, the same kind of eyewear. They want more excitement, and Mart has been creating the next generation of wave in terms of excitement, and a partnership like that brings more authenticity, touches upon nodes which are beyond just utility, and the product is looking beautiful. I just checked it out at a Lenskart store yesterday, and the best is yet to come.
And the thing is, you have now become part of the pop culture, so to speak. How big a market is that? I mean, what are you looking at? Who are you targeting? And what numbers are out there in terms of, projections and ambitions?
See, overall, if you look at eyewear, has been a very underpenetrated category. If you just few decades back, shoes used to be like that. We used to have a black shoes and a brown shoes, and at best a running shoe. And today, I don't think both of us would know how many pairs of shoes we own right now, and when we walk into a store online or offline, we check out one more, and if we like one, we pick it up. I think eyewear will go through the same level of transition. It's just that it requires work in terms of design, innovation, and then when you hit those trigger points with customers and you make it affordable and accessible, we see similar patterns. Industry average of eyewear has been traditionally about one pair every 2 years, which now moved to about 1.8, and Lenskart, it's almost about 4 pairs every 2 years. And that, I think, is something that we see growing further. And I think particularly with the growing myopia rates in all parts of the world, in Southeast Asia, where we are, almost 8 out of 10 people need glasses today. And why not wear fashionable, good-looking glasses, since we anyways have to wear them?
How much of a boost would this partnership with Mart provide?
See, it's difficult to give a number, but all of our growth is pegged on consumer choice right now. And, because it's a non-discretionary purchase. I mean, I wasn't planning to buy a pair of eyewear, and now I suddenly bought another pair of eyewear. So if you look at Lenskart, which has been growing, H1 grew about 25%. A large part of that growth comes from people buying more and more.
So this could just be the start of further collaborations if you're talking about, setting fashion trends and so on and so forth.
Oh, absolutely.
What are you looking at? 12, 24 months? Are we looking at more collaborations?
Many more.
What would make sense?
So we are partners with Disney, Marvel. We have done collections from Dragon Ball to Harry Potter, 3rd year in a row, the Batman collection, which is really popular here, Superman. We did Pokemon. We are tied up with designers in India, which is Masaba. And with Mart, this is just one character. And we are looking forward to doing many more characters coming forward. So I would say in the next 24 months, we want to just blow it out even more and have more fun with eyewear. And people also want to have more fun with eyewear.
What kind of growth are you anticipating? You have a global footprint. It's not just in India, although I think right now revenue, in terms of international revenue, it accounts for 40%.
Yes.
Do you see that being ramped up?
See, overall, I think both markets are growing. I mean, if we look at H1, both markets are growing at roughly about 25% odd, and we see that continuing. Lenskart as a business, we are trying to build a global relevant brand. We started first in Singapore and then expanded into Japan, other parts of Southeast Asia and Middle East. And a big part of that relevance creation in the local markets comes through design and innovation. So I think it's tough to predict right now how this will pan out, but I see both markets growing north of 20% healthy.
And the risk to that, perhaps, given that, perhaps people are anticipating a slowdown in the economy, that would hit consumption.
See, eyewear is very underpenetrated. I mean, if you look at the number of eye tests, we did just in the first half, we did about 10.7 million eye tests. We did 9 million eye tests approximately in whole of FY24. So this has been compounding at more than 50%. And most importantly, the number that matters is almost half of these eye tests are people who never got their eye tested before. I mean, Singapore, you're very well aware, every child here gets myopic, almost large part. I mean, I was reading some stats, 83% people get myopic in Singapore by the age of 18. And, at Lenskart, we are creating the market. We are making eyewear reach people who would never get it before. In Singapore, we sell 2 kids' glasses for as low as $50.
And we know eyewear has gone tech. And you've talked about how AI, AR are crucial to your growth projection. Talk to us about how you're incorporating all of that. What can be anticipated? You're wearing a high-tech glasses right now.
Yes. So I think, look, it's the next computing platform. The way I see it, there was laptop, and there came the mobile, which was a very good extension. It didn't make laptops go away, but it did make a lot of things move to the laptop, like browsing and consumption. And now with this, eyewear becoming a computing platform, which I'm very positive about, a lot of stuff that we do on the mobile will move here. One of them is being payments. So one of the things we have integrated in our new eyewear, which is coming, is that you'll be able to scan QR codes, no need to pick up the phone, enter a PIN, scan, and do all of that. Photos, which is now heavily used on mobile, I think will move here today. I was just at Gardens by the Bay on Sunday with my son, and I could just look up in the sky and record the whole beautiful scene. So I think a lot of that would move. I think a lot of logging food, getting information of the context. So it is going to be a big computing platform. The other area where I think tech would be heavily involved in style, as we just spoke about. I mean, we just launched an AI platform on our app where you could just sit in front of the mobile phone and it knows your face shape, it knows the clothes you're wearing, and it could recommend this is what you should be wearing for your interview today. Right. And that I see a lot of power. And then, of course, accessibility, like we have seen in e-commerce, it has been missing in eyewear. But at Lenskart, we have been building a fully vertically integrated stack all the way from manufacturing to retail, which we have not seen in custom manufacturing categories.
So what kind of investments are you putting into AI, AR, R&D within the company? And, what kind of returns are you anticipating on the back of that?
See, at Lenskart, if you look at the overall thesis that the company has is investment into talent and technology. And eyewear has been deprived of that. It's difficult to say where are we putting, because everything is becoming AI today, all the way from our supply chain integration. So let me give you an example. Today we do eye tests in Mumbai, but the optometrist is not sitting in Mumbai. They are sitting in Kolkata, and they're doing an eye test in Mumbai, where optometrists are difficult to find. One of the biggest problems that Asia is facing is where we have about 35-40 opticians/optometrists for 1 million people. That's just not going to be enough. And so what we are working towards is, can we bring AI to do self-eye tests, which is already under pilot right now in a lot of locations? Can we move eye testing to mobile phone, which is a pretty powerful camera? So that's one area to bring access into the ecosystem. Second is, can we do this in a centralized way? Because doing it in a locally distributed way is not scalable. It's very, very expensive. So we today in our factory ship glasses in more than 60 cities next day. So, you place an order at 9 p.m. In Singapore, we just launched a 2-hour service for you to get products. So I think there's a lot of tech involved there. And then in the styling angle, which, one undermines. But I think that is where, we don't buy mobile phone today for talking on the phone. We buy it because the camera keeps getting better and then you need the next version. So I think that element is very, very important.
So it does seem like you don't buy eyewear now for seeing things. It's also for taking pictures and so on and so forth. You have become a tech company, essentially. I mean, what is the strategy going forward? I mean, how will the company look like in 5 years, for instance?
I mean, I won't say we have become. I believe we started as a tech company. None of us are really from an eyewear background. If you look at except one of the co-founders, most of us were working in the tech domain before. And we today, if you look at majority of our payroll costs, we have more than 500 engineers developing solutions from selection to choice to affordability to accessibility to now smart eyewear to the next version coming where there'll be waveguides. So in the next 5 years, I think Lenskart transforming from a eyewear company, tech-enabled eyewear company to a tech, eyewear and data company. Because what you're capturing in this device right now is all going to get into the Lenskart platform. And we are building it full stack, all the way from hardware, firmware, software. So when you log your food from a B glasses, we call these B, and I say, okay, hey B, tell me, should I be eating this today? That information is traveling into the Lenskart app. That makes me understand the consumer better. If you're getting bored today, you want to chat, okay, hey B, I'm getting bored, can we chat? Just like a counselor or just like a friend, that information. And that tells us a lot more about consumers, and that builds a subscription ecosystem in the future.
So you become a one-stop shop. Is that the end goal?
I mean, our
providing
goal,
all the services. And I'm also wondering right now, as you look to the future, who do you view as your competitors? Who are you competing with globally?
So first question first. I think the way I look at it is that eyewear can play a very large role in transforming your quality of life. And we have seen that with many other categories, but this being right in front on your face, and the more it can do for you, and that's why our tagline is do more, be more. I mean, and our mission is transform the way people see and experience the world. So it clearly fits in what we have been trying to do. And our competition, to be honest, is people habits, right? If you look at today...
No, I mean companies. Who are you competing with for market share?
I mean, it is difficult to say because our approach at doing this is very different, and we are not really in any sense trying to just consolidate the market. We are creating the market. I mean, I just told you that more than 45% of the eye tests we did are people who never did eye tests. The people who are wearing glasses, many would have never worn glasses if we didn't create some of those solutions. I mean, we're delivering glasses next day, same day, and that creates demand. So I'm not able to put right now a pen on an eyewear. To be honest, we do not have, especially in this part of the world, players which have been able to organize it and push the bar on customer experience every day.
What are you most excited about? What are we not seeing today that you think you will create in due time?
See, one thing which we are not seeing today is just the size of the market, right? I think often people go at market numbers. I think while they are large, they're often understated. I think what we are not seeing is that there's a market creation under the carpet which is happening. Just to give you an example, we used to deliver glasses in 7 days. Became 4 days, 3 days. Now we deliver glasses next day, and now maybe even same day. Now what that is doing is it is creating a market which never existed before. And I think a lot of people are not seeing that. Second, I think just the multiplicity which we are seeing, that people are not going to wear one pair of glasses. And I think we have seen the journey from 1 to 4 every 2 years. I won't be surprised, and I'm quite confident, I would say, on the other hand, of this 4 becoming many folds more in the times to come, which I think it's difficult for us to anticipate, but we could not guess that about shoes at any point in time. And this is even more powerful from where it sits, and in a digital Zoom world where only this part of the face is visible. And third, I would say, is just the computing angle. I think this is the next computing platform. This is with camera, but very soon the next version will have waveguides, so I can look at you and I can get a little bit of snippet. I can do translations. That, I think, is going to happen faster than what people are imagining.
I just have one final question. You IPO'd recently, valuing the company at about $8 billion. Do you think $8 billion reflects the kind of value you will bring in the years to come, or should you be valued higher than that?
Well, as far as look, IPO is not a destination, right? It's a beginning of a journey in many ways, and it's a milestone. And we have been here for about 14 years now. I think we stay committed to building at Lenskart. Even after serving 25 million odd pairs, we only have scratched the surface. We own like 5% market share. So there's a lot for us to do. And myopia is a problem that remains under-addressed right now. Even in a market like Southeast Asia, there are no solutions that exist right now. And there's a lot more ahead of us. And I think valuations are a function of growth.
That's not answering my question. So you think you should be valued higher than that?
I'm not saying whether I think we are not working for a valuation just on the IPO, right? We have to work hard, and at the end of the day, it's the numbers that will speak, and the investors will value on our performance, and that's what we've been doing in the first 2 quarters of this year.
Peyush, thank you so much for popping by. Peyush Bansal, co-founder and CEO at Lenskart. Still to come, Microsoft pledges to invest almost $18 billion into AI and cloud computing in India over 4 years. More details just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom for AI fails to consider how many people will be able to afford the additional goods produced. Marks adds that some firms are piling on aggressive debt as big tech spends vast sums in an AI race designed to keep smaller rivals from catching up. Now let's stay with that topic of big tech spending on AI, because Microsoft is looking to pour nearly $18 billion into India over the next 4 years. Our Asia Tech correspondent Annabelle Drulis is with us. And Belle, this announcement comes as CEO Satya Nadella is in India. What do we know?
Yeah, it's a really major announcement that Microsoft has made for its ambitions around the India market in particular. So he had a meeting, Satya Nadella, with the Prime Minister Narendra Modi, and in that meeting or around that meeting, he made this big announcement that Microsoft is planning to spend $17.5 billion on the country. So you got this tweet or this, social media post on X essentially, but talking about this commitment, it's the largest ever that has been in Asia, but looking at a few different areas. So scale, skills, and sovereignty. That's what they're saying. It's these 3 pillars, and that very much aligns with Narendra Modi's mission to build out a broad AI ecosystem across the country. So yes, that is the latest from Microsoft. In terms of where this sits with other investments, I mean, Satya Nadella, he's someone who's actually born in India, but has made several trips, and the latest one being in January to the country, where they also pledged a $3 billion investment. So $17.5 billion builds on that investment, and it just really shows as well how Microsoft is, or rather India is increasingly drawing the attention of a lot of different AI power brokers, because you've got this visit here from Satya Nadella, but it also follows, for instance, the Anthropic co-founder visiting back in October. And as well, we're expecting NVIDIA's Jensen Huang, also Google DeepMind executive, also to visit in the coming months.
And speaking of Jensen Huang, Bell, we're getting details on why President Trump has pivoted on NVIDIA's H200 chips. What's the story here?
Yeah, this is some great reporting from our colleagues over in the US. But what we understand is it's really around the competition that the Trump administration sees. And it's the competition between NVIDIA and also the chip leader in China, and that's Huawei. And so what we understand is that the Trump administration looked at a similar or comparable AI system from Huawei to one of NVIDIA. So they looked at the Cloud Matrix 384 from Huawei, and they looked at the MVL72 from NVIDIA. So one is built on the Ascend AI chips, that's Huawei's lineup. The other one's built on Blackwell architecture. And what they found, these two systems actually have pretty similar performance. And so that obviously caused some shockwaves, because the US is sort of banking on it having technological supremacy. Huawei seems to be catching up, and that added a sense of urgency to why they made that pivot.
Bell, thank you so much for that. Annabelle Drulers in Hong Kong. Now, meantime, HSBC CEO Georges El-Hadri is ramping up the integration of generative AI into the lender's operations. Speaking on the new Leaders with Francine Lacroix podcast series, El-Hadri discussed the technology's impact on productivity.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging.
The dream.
Process. 170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times. And we're not talking
in 12 months.
In 12 months. We're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those, in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
Coming up, our exclusive with Barclays Bank India's CEO Pramod Kumar on the lender's strategy and outlook for deals in India. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on shares of Indian e-commerce platform Meesho as it makes its trading debut in Mumbai. The SoftBank-backed firm raised $603 million in its initial public offering that was fully subscribed on the first day of book building. Today's listing is closely watched as a gauge of investor appetite after a string of blockbuster tech IPOs. Take a look at that, 50% on the upside. For more on Meesho, let's bring in Bloomberg News' Ashutosh Joshi in Mumbai. Ashutosh, it is a test for the appetite in India's IPO.
Yeah, thanks, Haslinda. Thanks for having me on the show. IPOs in India are already seeing yet another blockbuster year. Last year, India raised about $21 billion through new listings. This year, with 3 weeks to go, already this benchmark has been broken. So 2 consecutive years of records in India. A bulk of it is coming from demand from domestic investors as well as foreigners who are selling in the secondary market have participated in the primary market issuances. Technology-backed IPOs have been a big theme this year. We saw shares of urban company Lenskart doing well upon their debuts, and in the same line we are expecting strong appetite for Meesho's shares as well.
All eyes on Meesho because half of the IPOs in India so far have done pretty badly. This might change sentiment somewhat.
Yeah. Out of 90 odd IPOs, those listed on main board indexes, about 30% are under the water, trading below their IPO prices. But at the same time, we have seen some of IPOs such as Urban, Ether Energy doing exceedingly well. Their shares have doubled on the trading debut itself and have continued to held the gains. We can see the investor appetite for technology-backed companies, especially companies which started as a startup and then went on for debuting on exchanges. There is a special interest among investors for these companies, even though some of them might have been loss-making at the stage of listing. But investors are hopeful that these companies provide a longer growth opportunity, and some of them can also change the existing supply lines in the market and expand their presence. So there is investor interest for these names.
As you said, it is a loss-making company, but the focus is on its growth potential. What kind of growth potential are we anticipating?
Some of startups like Lenskart as well as Urban, we have seen their business models were able to expand rapidly backed by their technology support. These companies also have expanded their businesses quickly because they were able to source and manage their supply chains efficiently. Same is the case with Meesho, which broadly focuses on a segment that some of its larger peers may not, and hence there is traction, especially in the rural parts of India, for services or the products that are available on Meesho's. Some of the most selling items on Meesho's platforms are dresses. Those are valued at as cheap as $4.
Ashutosh, thank you so much for that. Ashutosh Joshi in Mumbai. Now joining us exclusively is Pramod Kumar, India's CEO and Vice Chair of Investment Banking APAC at Barclays Bank. Pramod, good to have you with us. First off, just to get your insights on what's happening in the IPO market in India, it seems pretty hot. We have Meesho surging more than 50%. What do you make of the market sentiment in India?
Look, as we've seen, we've had 2 consecutive years of very strong IPO market. Many of these companies offer very high growth. They've been held by private equity venture capital investors. They're catering to a very large market opportunity. And domestic institutional investors and retail investors continue to invest in these companies because of massive growth that they offer, right? So despite, I would say, relatively weaker sentiments or interest from the global institutions, the domestic institution and retail investors continue to invest. And I do expect that sort of trend to continue as we head into 2026 as well.
Is there reason to be concerned that some of these companies are actually loss-making? Shouldn't you be questioning fundamentals even as you talk about growth?
No, of course you should be questioning fundamentals. Loss making is sort of one criteria, but I think people buy shares on the basis of potential that they hold. So in a very strong market, as we've seen in this year and last year, most of the companies you would see are market leaders. But, when you see such frenzy, there's always a likelihood of some of the companies, getting, mispricing their IPOs and therefore their stocks not doing well. As you heard, from Ashutosh. There are some companies that are sort of, trading below their offer price, right? So those things happen, but as long as we see majority of these companies do well, I think the market will support. Yes, but investors should really tread with caution and see which are the institutional investors that are coming in as anchor investors. What's the fundamental business model of these companies? Certainly you can't take your eye off that.
I ask because SEBI actually requires a company that's listing to have a track record of distributable profits in terms of Section 205 of the Companies Act. That's part of the reason why that question was posed. And, considering that Meesho is actually loss-making, I just want to bring your attention to investor appetite, foreign investments, in particular foreign funds. What would it take for foreign funds to return to India?
Look, I think a couple of things. We've seen pretty flattish index this year while, earnings continue to grow. We do believe that we're now getting into a zone where multiples are looking attractive. Most of the global institutional money really is centered around, U.S. If we see continued slowdown in the U.S., then investors are going to look outside. India, I would think, is now probably at a stage where the current multiples and expected earnings growth will make it sort of look relatively attractive. I do see, some of the other emerging markets like China, I think are looking sort of relatively attractive, probably 13, 14 times multiples versus, 20 plus multiple for India. But, the global money will flow as we see slight slowdown in the US, and therefore India could benefit. So 26, I would think, maybe beginning sort of second quarter or second half, we will see more flows coming into India.
And we had the RBI cutting rates by 25 basis points. It's adding liquidity to the system. Would that perhaps improve the appetite for Indian assets?
Yes, certainly. Look, on one side, RBI's liquidity measures are really to sort of facilitate, greater credit growth in the economy and continue to sort of propel the strong growth that we've seen in India. But yes, increased liquidity as we see transmission of these rates in the hands of consumers and users. Yes, that will improve, their ability to sort of make investments further.
Do you see the cut that we saw recently as the last leg of the RBI's easing cycle? How much scope does it have to cut in 2026, you think?
Look, I do believe that we've front-loaded this. Inflation's under control. There was a unanimous cut, since last year, right, since 2025 Feb, we've seen 125 basis cuts. I think that's a material cut that RBI has sort of already undertaken. I do believe that we take a pause from here on. See the continued trajectory of inflation, how exports do, how does rupee perform from here on, and you might sort of might not see any cut in sort of January, February, but maybe a little later in the year.
And speaking of the rupee, it keeps testing record lows. Should the RBI be doing more? Should it intervene more to provide support for the currency?
Look, RBI's stated policy is to, not really, let sort of huge spikes take place, right? So we've seen rupee depreciate by more than 5% this year. There is obviously an impact of, our trade treaty with the U.S. Delay on that's really playing on the minds of both exporters and importers, and that's led to a sharp depreciation. I do believe that if we, on one side, governments actually signed up treaties with various other countries The exports are being diversified as a conscious effort. And if the treaty with the US gets signed over the next few weeks, as one's sort of anticipating, I think the pressure will come off rupee. Inflation is, as I said, quite moderate. So therefore, I do believe that in the short run, I think the focus would really be on the treaty that could just kind of change the sentiments a little bit.
And Pramod, looking at the market, some say that India perhaps has become a more compelling fundraising hub. I mean, the IPO hot market is adding to that sentiment. I'm just wondering, on the back of that, do you see, volumes in M&As accelerating perhaps in the next 12, 24 months?
It's interesting. When we see very strong equity markets, the M&A volumes tend to be slightly slower, relatively speaking. We've seen very strong equity markets this year. M&A growth has really been relatively less. As we head into the new year, I would see Indian equities or IPO market continue to be strong, but we will see more and more activity. There is a lot of money with the private equity investors. India looks a very attractive market within the APAC. There are material opportunities there. The Indian corporate balance sheets are very healthy. They are at the lowest sort of leverage levels. And we've seen activity amongst the Indian industrial houses, both domestically and outbound. And we continue to see financial sponsor interest. So I think the M&A activity will continue to be strong. The IPO activity may probably go into a third year of very strong performance, relatively speaking.
And which sectors do you think will be most active?
Look, from a deal activity point of view, and I'm clubbing both sort of IPO and M&A here, consumer tech, consumer businesses, given the massive opportunity that India offers with its large population and growing disposable incomes, will continue to see more and more deal activity, whether it's private capital raising, which gets classified under M&A, or IPOs. Amongst other sectors, we will see within M&A, infrastructure, renewables continues to be very strong. Healthcare, pharma, industrials hasn't seen that much, but we do see more and more activity in that sector. So tech would come back, in my view. I think tech's been relatively quiet, but valuations are getting to a place where there'll be more activity, and we do see some of the large tech services companies now having more appetite to act. So mostly sort of across these sectors, but generally I think we'll see a fairly robust M&A activity and equity capital markets activity as we get into 26.
And what's the risk to that projection, Pramod? I'm just wondering, everybody's waiting for that trade deal between the US and India. Should that fail to materialize in the next 6 months, might that impact sentiment?
No, that definitely will impact sentiments. We will see, more sort of, stable rupee. Sentiments will certainly improve. It's been, I would say, there's been a overhang for last several months on this, and everyone's sort of watching. I think either before end of the year or in January, we would see that sort of getting sealed.
And Pramod, we know that the RBI now allowing lenders to provide acquisition financing. This is a highly competitive space, and Barclays is one of the leading players in this space. How do you intend to stay competitive?
Look, on one hand, the overall activity will improve, the supply of capital will improve, right? So that will just expand the overall activity and financing available. That should spur and increase the overall market size. Secondly, look, from clients' perspective, they're looking for certainty. And we do believe that, a track record of consistently delivering on complex and large transactions will certainly be a strong support to us continuing to win business. So I'm really not sort of concerned about this. I do believe that the overall wallet will increase, the activity will increase. Maybe increased supply would lead to slight compression in pricing, but I would still believe that the clients would, really weigh certainty and the ability to sort of, deliver on complexity and in time far greater than anything else. So, I would see, a significant sort of business opportunity continues to be with us.
And what are you most excited about for 2026 as you look to grow the business in India?
Look, as we've seen in the last few years, there continues to be strong global interest, strategic, while we've seen FPI sort of investments slow down and more sort of being pulled out of India. I do believe that's going to change. And there will continue to be more and more global financial institution interest. One of the large segments for our business or client segments is sort of financial sponsors. We have virtually all the global financial sponsors here raising Asia dedicated funds, India dedicated funds. There's emergence of domestic private equity funds. So we will continue to see them deploy capital and also monetize their investments. Both provide opportunities for institutions like us. Our Indian clients continue to be more active in raising debt and equity and also undertaking M&A both domestically and cross-border. So that'll continue to be, supporting a robust deal activity. Our multinational clients continue to actually grow their India business. We're supporting them through, working capital, cash, trade, etc. So I think, look, India is amongst the fastest growing major economies in the world. We will continue to see both domestic and global interest in the country. So all of that really, I think, just provides a strong environment for us to grow.
Pramod, great insights. Thank you. Pramod Kumar, India's CEO and Vice Chairman, Investment Banking APAC at Barclays Bank. Coming up, saving the trade deal. The U.S. Trade Representative is reportedly speaking with a top Indonesian official this week to keep the agreement from collapsing. Keep it here with us. This is Bloomberg. You're watching Insight. The Financial Times is reporting that U.S. Trade Representative Jamieson Greer is set to speak with a top Indonesian official this week. That's as the two countries work to salvage a trade framework at risk of collapsing. Let's bring in Bloomberg executive producer Soraya Permatasari in Jakarta. Soraya, why is it collapsing?
Yeah, so thank you and good morning from Jakarta. Yes, so as reported by the Financial Times on Tuesday, citing sources, Jamieson Greer is supposed to have a discussion this week with the Chief Economics Minister, Erlangga Hartarto, to revive a trade framework deal announced back in July by President Trump, but have not been implemented. Now, a deal would see U.S. tariffs on Indonesian goods reduced from 32% to 19% in exchange for some concessions. Now, it is still higher than the universal 10% tariffs, but a significant cut nonetheless, if it materializes. Apparently, there's been a concern from the U.S. side that Indonesia is backtracking on agreements to eliminate non-tariff barriers on on American industrial and agricultural exports. They feel, apparently, that officials in Jakarta felt little urgency to finalize the deal or move quickly to fulfill the commitments, and that they have intentionally looked to delay the concessions. Now, Haslinda, just to take you back to what was agreed at the time in July, Indonesia had planned to purchase some $19 billion worth of American products, including mainly 50 Boeing jets, and erase duties on U.S. imports. Indonesia also agreed to eliminate some local content requirements. Now, this specifically refers to what happened late last year when the government banned the sale of Apple's iPhone 16 because the company was seen as failing to comply with domestic manufacturing requirements. Now, the ban was eventually lifted in February after 5 months, as both sides agree on terms, which include Apple setting up a plan to produce AirTags. Now, we tried to contact the U.S. officials, but they did not immediately respond to our request for comments. But we have yet to get any confirmation from the Indonesian side, which I'm hoping we will get shortly. So stay tuned.
You got to wonder what the chances are that Korea will be able to get that trade deal back on track. How much appetite is there? How much urgency is there on the Indonesian side?
Well, Indonesia is definitely trying to get a deal implemented as soon as possible. But there are a number of issues that the Indonesian government thinks need to be ironed out. That has to do with, the national sovereignty, and which is not at this moment still very clear in terms of details. So we will just have to wait and see what comes up later this week if it happens.
Soraya, thank you. Bloomberg executive producer Soraya Permatasari in Jakarta for us. Now, before we go, here's a look at our guests for tomorrow. It's Fed Day. We'll break down the decision and the market reaction, plus insight from Vantage Markets analyst Hee-Bei Chen and Zuma Wealth CIO Terry Speth, and we discuss the outlook for the economy and the rupee with India's chief economic advisor V. Anantha Nageswaran. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.